Welcome back. Neogen Chemicals is in focus. The company's delivered an over 30% growth in revenues in Q2 on a year-on-year basis, even as the operating margins and profits took a bit of a hit. But it does expect that orders from Europe to start scaling up in November onwards, and things will accelerate perhaps January onwards. Harin Kanani, the managing director at Neogen Chemicals, is now with us on the show. Mr. Kanani, afternoon, and thanks so much for joining in. Your margins in the current quarter as well as in the prior quarter were about 16.5%. How do you expect the margins to trend? Because these margins appear a tad bit subdued.
Hi, so thanks for inviting and thanks for the question. We've shared in our conference calls earlier that, as you are aware, like 25% of Neogen's business comes from lithium chemicals, and the lithium prices have reached 5 times high as compared to what used to be about a year ago. So I think the margins is just in a percentage point of view, the margins are lower, but the absolute margins, whatever we had predicted for the current year, we are on track to achieve. So the target this year was to do a 600 crores of top line and about 110 crores of EBITDA. So we are already on track of that. We've already done 50% of that. And second half is always higher for us. So that's why, for the year, whatever was our targets, we are still reaching that. It's just till the lithium prices remain elevated, maybe 1 or 2% as a percentage will be down, but the absolute margins will still be protected. Okay. And the other thing factoring here is that our Dahej site is going full utilization levels. So right now it's somewhere midway.
Okay, I think we've lost the line with Mr.
So help us improve our margins.
Okay, that point is understood that lithium, the costs of lithium really are not in your control at this point. But I just wanted to get a sense in terms of the demand trends and whether or not this volatility in input costs or elevated input costs is actually impacting demand for you in any form or manner, because your revenue growth has been quite strong. It's up around 30-odd%. So just give us a sense in terms of the demand dynamics and how that's playing out and whether input costs are impacting it.
Yeah, so the demand, let's say, in the bromine derivatives remains strong, which is where we are serving pharma and agro markets. More and more customers who are relying on China wanted to shift to India. So that trend continues. With our new Dahej facility, which is state-of-the-art kind of a facility, even more larger, industry leaders are shown interest to work with Neogen. So this will ensure our continued growth in the future. In pharma, there is a little bit of an inventory correction happening, and we see slight reduction in our demand from our regular molecules, but our new molecules and our new customers tend to do well. And that's why overall for this year as well as next year, we have maintained our target. In fact, we will overshot it by whatever is a higher lithium price impact. But on our regular lithium price basis, we are already meeting our targets and doing slightly better. When we talk of the impact of the lithium prices, what we have seen is some of the Indian applications at this high level of lithium price are not able to sustain the demand, and the demand is a little bit lower. But what is helping us that worldwide there is a shortage, and Neogen is one of the company who is able to source lithium efficiently. So because of that, international new customers for new applications are coming to us. Also, we remain on track to continue working on our lithium battery materials for the EV and the energy storage segment. So that investment is also continuing. So in a short term, the new demand from new customers in international will make sure that our volumes don't go down. We will keep meeting our targets and maybe even do better once the demand comes back in India. And going forward, the work which we are doing on lithium battery materials for the electrolytes and the electrolyte salts is something which will also keep driving us forward.
How much does pharma contribute to your overall revenues? Because I think that's a space where you said certain molecules face some issues. You are sitting on inventory. And when can it recover?
So I think it's about 50 to 60% of our revenue comes from pharma.
Okay.
And it's we make more than 150 molecules, but let's say from our top 10 molecules in pharma, there are 1 or 2 which are seeing slightly lower demand. So while, these were our regular molecules, so we already made the product. We didn't want to have a low utilization in the plants. So we are sitting on inventory, but this will get sold off by, in the second half. And we have already shifted those plants to make other new molecules, which we are developing. So that's why overall we are in a normal position, and we expect to continue to achieve whatever we have already planned for this year as well as for next year. And we continue our growth plans for increase in organic capacity as well as inorganic capacity in lithium, as well as the trial facility which we are planning for electrolyte salts and electrolytes. So all those remain on track. So there's no pause. The only thing which we are still working on is a larger electrolyte facility on which we are still deciding the capacity based on customer inputs. And we are hoping that by, let's say, March end, we would have a capacity and a scale of that business in mind in next 6 months.
Just getting back to that point about pharma, you're saying 1 or 2 molecules out of your top 10 molecules in the pharma business are a bit under pressure, but you are shifting production of these, molecules, which means you're going slow. So is this a long-term issue with these molecules?
No, so we have
a multi-product. Till your inventory correct.
So we have a multi-product kind of a facility. So in the same facility, we are basically, we can make other molecules as well. So normally this capacity was blocked for these molecules, but we always have a very healthy pipeline. So we are using this for the next 6 months. My sense is historically, whenever such inventory correction happens, the demand is overall a bit subdued, for maybe couple of 1 year, 1.5 year maximum. And again, when it's subdued means it's not zero. I mean, it's just a little bit lesser. So that's the only part. So we know eventually these molecules will come up, and also we can keep making other molecules in the facility till that comes. And whenever the requirement is back, we will be there. In fact, we are also expecting, so we are one of the recipients of the PLI benefit in pharma, and the benefit will start kicking in from this year because we are making intermediates for pharma. So even that will support us when we have to compete more competitively against, Chinese competition going forward. So we can even be more aggressive for this pharma molecule.
I just on that point, since we are talking about the PLI and all of that, I wanted your thoughts on whether China +1 is actually a real opportunity and whether Europe +1 is an opportunity for the company as well. If you could just give your brief thoughts.
Yeah, so I think, one of the areas of work is bromine-based chemistry, and bromine, not only customers desire to shift out of China, but economically also the price of bromine is highest, which is our raw material. So it's highest in China and it's relatively lower in India. So that also gives us an additional advantage. And the shift from China to India has been happening for last 5 years, which has already helped us increase our revenue. We still keep seeing that with the rolling lockdown still continuing in China, many European customers are worried and they are now getting more and more determined to try to find a source in India. So this is on the pharma side. And on Europe, I think, people are watching. I mean, my sense is that in Europe, people still feel this is a temporary phenomena for 6 months, 1 year, which they have to go through. But yes, I mean, they are thinking that, okay, if they can think of India as an option. So I don't think in Europe, people are thinking more structurally that, okay, we are going to be in this high energy prices forever. So it's more like a short term that, okay, they are planning to shift over to India. Of course, Neogen has a good export in Europe that continues. And some of our European competitors closed down about 2 years ago because of competition pressure from both India and China. So that has also helped us because our Dahej site capacity came online just around that time. So many of these customers who were buying from Europe were shifting to India. But again, this is much before what we call as Europe +1 happened. I mean, this is something which is helping us for last 1 year.
Wonderful. Well, we wish you luck and hopefully it's going to continue showing in your numbers as well. Thanks, Mr. Kanani, for joining in and talking to us. So that's Neogen Chemicals. Well, we need to take a short break, but on the other side, more stocks in focus.